All right. Welcome, everyone. I thank all of you for being a part of today's meeting with Daniel Kemp of Morningstar Investments. As I usually do, I have to start off our meeting with the disclosure document. So I'm going to do that right now. So I will ask you to forgive me if I'll say fumble around a little bit while I share my screen. We do have members of the team that are with us as well, so hang on one moment. Okay, hopefully you can see the disclosure document that's on the screen right now. I will read it as we usually start. This webinar was created on September 29th of 2022 and is provided by Tranquilli Financial Advisor, LLC, and Morningstar Investment Services for educational use only. The opinions expressed herein are as of the date of the report and are subject to change without notice. Forward-looking statements cannot be guaranteed. This material should not be considered financial advice or the offer to sell any product. Tranquilli Financial Advisor and Morningstar Investment Services reserve the right to modify their current investment strategies and techniques based on the changing market dynamics or client needs. There is no guarantee that their assessment of investments will be accurate. The discussions, outlooks, and viewpoints featured are not intended to be investment advice and do not take into account the specific client investment objectives. Before investing, an investor should consider his or her investment goals and risk comfort levels and consult with his or her investment advisor and tax professional. Information has been obtained from sources believed to be reliable, but its accuracy and completeness are not guaranteed. Past performance is no guarantee of future results. That is copyright Tranquilli Financial Advisor 2022. I'm going to introduce the team. I'll ask Sarah to wave. You've had communication from I just can never introduce her as anything other than my lovely and beautiful daughter. So there she is. And for everyone, we have Mitch Fisher with us as well. You know Mitch through work that he's as a client service advocate for Tranquilli Financial Advisor. We have Garrett Williams of Morningstar Investments also joining us. He has worked with Tranquilli Financial Advisor for 5.5 years. And I would say the most awesome thing that Garrett has done, other than working his way through the gauntlet that is Lou Tranquilli and investment conversation for the last 5.5 years, is make the introduction to Daniel Kemp, who I do have his bio in front of me as well. And I'm going to, before I bring him in here and have the conversation with Dan, thank Garrett for doing such a great job of introducing me to Dan Kemp, who at this point has, I'll dare say, become a friend. I'll even let Sarah turn her camera off at this point if she'd like to do so. And from here, introduce Dan Kemp. Dan is the Global Chief Investment Officer for Morningstar Investments. He and I have had numerous discussions, and one of the best discussions we had is when he asked me, how do I join you on one of your video conferences? And here he is joining us on one of our video conferences. So Dan, welcome. Thank you so much for taking the time, especially on a day. Today is quite an interesting day, to say the least, to have this conversation. We've all said, turned the phrase, sometimes lucky is better than good. And aren't we lucky to have you join us today for this conversation?
Well, thank you, Lou, and hello, everyone. I feel really lucky to be here. It's just such a privilege to talk to the folks who entrust some of their money to our team here, and that's a privilege I get to experience now and again. And it's really great to be here today, despite everything that's happening with markets.
Hey, this is the work we have chosen, Dan. So we understand it. Today, it's a great day to have this discussion. So with that, I'd like to jump right into it. Certainly, I want to establish the fact that everyone can hear that you're from the land of the original Jersey, and I am from the New Jersey. Okay, so the bottom line is, I sent out your bio and I said any words that are misspelled, blame it on the motherland. Okay, so anyway, with that. We talked a little bit in preparing for today about the Federal Reserve, the U.S. Federal Reserve, certainly with interest rates being increased all over the world. We'll focus on the U.S., the Fed increasing rates, the stock market's reaction. We talked about asking to start with bonds. Where do they go from here? And then get into the side effects of all that the policymakers will say within the U.S. and then outside the U.S. What are the side effects of these massive increase in interest rates?
Yeah, sure. So, as everyone knows, the U.S. Treasury bond is probably the most well-known investment asset across the world. It's held by all sorts of investors, and it's governed both by the Fed itself, who sets short-term interest rates, and then partly by the market, who buy and sell these securities, this debt that the US government is taking on. And these bond markets, of course, operate all around the world, but the largest and the most renowned is, of course, the US Treasury market. And what we've seen over the last few months, going back into last year, is a real change in the way that the Fed thinks about interest rate policy. So if we cast our minds back about 20, even 25 years, then over most of that period, the challenge has been that inflation is too low in the US, or has been too low in the US. So we've had very, very stable prices. And the problem with very stable prices is there's always a danger that you move to something called deflation, where you move to prices falling. And that may not seem like such a bad thing, particularly at the moment, but what it does, it discourages investment, because people will put off investing today, put off spending today, if they think that they'll be able to get more for their money down the line. This is what's been happening in Japan for much of the last 30 years. And so deflation is devastating to an economy. And so the Fed plans to have about 2% inflation. So for most of that period, what the Fed's been trying to do is keep inflation up to a level of around 2% and ignore it when it goes a little bit above that because of energy and food prices. Now, what's just happened, of course, is that we've had this incredible economic event linked to COVID, and we've suddenly gone from an economy that was put into the deep freeze to an economy where demand came back very, very quickly. People were out spending money, sometimes money they'd saved over the COVID period, and they were spending money at a time of broken supply chains, where factories weren't operating at full capacity, needed the shipping lanes, and so all of that money was chasing a small number of goods and trying to get employees back into the workplace. That was having an impact on wages. And so what we've seen is this huge spike in inflation. Of course, then that's been exacerbated, particularly where I'm from in Europe, by the war in Ukraine, where obviously that's affected energy prices and also food prices, because Ukraine is such an important food producer. So to put it in context, the whole system's changed, because now the Fed's really worried about inflation, and they've been putting up interest rates really aggressively to try and calm inflation. Now, the real question is, are they getting it right? Well, I can give you the answer with certainty. The answer is no, because no central bank can ever get it right. You're dealing with an uncertain future, and so every central bank will be wrong in one or two directions. They may be tightening too quickly or tightening too slowly. And that leads to different outcomes. We'll talk about that, I'm sure, in a minute. But we've seen this very aggressive stance towards inflation, which is already seems to be peaking. We don't know what's going to happen next, but that could start falling, in which case we could move fairly quickly from a situation where the Fed is worried about inflation being very high to one where it's worried about inflation going back to levels that are too low again. Now, that'll take a while, but the key thing for everyone to remember is that the future is uncertain. And when we're thinking about it, we can't just hold one ideal future in our heads. We've got to think about a range of possible futures. That was a very, very long answer, I'm afraid.
No, that's okay. That's why you're here, Dan. And I'm going to summarize. You'll get to know is I take in the information that you or anyone else who comes on and has this conversation with us, and I like to summarize it. So really what you're saying is that central banks, they're not perfect. And I will say that I don't think anyone expects them to be perfect, other than when any of us would turn on any kind of financial news, any kind of conversation analysis, the instant analysis world that we live in. you do expect it to be perfect. Well, how could you not get that right? Well, as the saying goes, hindsight is 20/20, and these are people making decisions that look correct at the moment. And to bring it back to where do bonds go from here, what are the others? If you would just give me a brief of the side effects of the aggressiveness that we're seeing, or aggression that we're seeing in the short-term interest rate increases.
Yeah, of course. So where bonds go from here will partly depend, as we said, on what happens with inflation, people's perceptions. But the key thing to remember is that bonds are now a much better investment than they were in the past, because yields are higher. And if you're buying a bond today, you're buying a much higher income stream in the lowest risk asset in the world. And so bonds are a much more attractive asset now. And that's where people tend to confuse themselves. We tend to like it when prices are going up, and we dislike it when prices are going down. But unless you need to spend your money right now, actually, as prices go down, of course, you get a better return. So it's uncertain where bonds are going, but we know they're much more attractive now than they were in the past. When we turn to side effects, then the side effect really is twofold. One is it has a slowing impact on the economy, but the other thing it does is make certain companies look far less attractive. So when analysts like me are trying to value a company, what we do is we think of it as a stream of future cash flows to the shareholders that own that company. And of course, the further ahead the cash flows are, the more we have to assign some risk to those cash flows. And the level of risk we assign to the cash flows is really determined by the level of interest rates that we see in the market, and also people's appetite for investment risk. So as the interest rates go up, people assign higher risks to those future cash flows, which means lower equity prices, particularly for shares, for companies where most of their earnings in the far future. And if you think about technology companies, then quite often the reason people like technology companies is because they expect them to grow really quickly and have very high cash flows in the future. But as you look at that through the lens of higher interest rates, those cash flows are less valuable, and so we have much worse performance from technology companies than we do from some traditional economy companies, and particularly things like energy stocks.
And that is, we'll say, the narrative right now: dividend paying, legacy type of stocks. We won't name any names here, but we'll just say that you can think of the biggest of big in the U.S. paying a dividend. Everything old is new again, kind of thing, as it applies to investing. Whereas maybe some of the FANGs, which, if you don't know that acronym, you can reach out to me and I'll be glad to share that with you. So, what tools remain at the Fed's disposal at this point? Based on lawmakers, they have their own way of handling this type of environment economically. What does the Fed have? They're raising interest rates aggressively. What other tools are out there for policymakers or the Federal Reserve to use?
Well, I think you hit the nail on the head, Lou, that the thing about the Fed at the moment is they have an enormous number of tools and very effective tools. So when interest rates get down to very low levels because they're worried about inflation being too low, then they run out of tools pretty quickly. And what we've seen out of the last decade or so, where we've had money being printed, where we've had negative interest rates in some part of the world, it's really tough to create that additional inflation. But when inflation is high, then the Fed has lots of, because of course they can raise interest rates very aggressively. They can change the way that the banks work, so they're less likely to lend. There's work that they can do in terms of issuance of different bonds as well. So the Fed has plenty of tools at the moment. So when we think about the future of inflation, The one thing that we don't have to worry about is that the Fed doesn't have enough tools to try and slow the economy down. The key is that they want to slow the economy down in a gentle way. And so the challenge for the Fed, they're doing the best they can, is to try and slow the economy without causing a big recession. So that's what they're trying to do at the moment. But in terms of what the future inflation may be, then the Fed has no shortage of tools. The US government has some tools as well. The problem is those tools inflict pain, and so it's a question of how much pain they want to inflict on the US consumer, US businesses, and that's the calculation they're trying to work through at the moment.
Okay, and I mean, we're feeling pain today, being again a good example of what the markets look like. Think, and this is a compliment to Tranquilli Financial Advisor clients, to you. The phone has not been ringing off the hook. We have a methodology. This is not a day trading operation. We're not asking for any day trading information from you. This is a long perspective, regardless of where someone fits on the risk tolerance axis. You want to take a long perspective. That's just what we're doing. So really, I think what I hear you saying is that there are many tools available because we are looking at inflation. If we were facing deflation, there aren't so many available. So while it's painful, while it's disruptive, a little bit harrowing, of course, it's also rather normal that there are tools in place for this. So the R word came up on during a previous conversation, one of our conferences, meetings like this with someone, recession, the yield curve, and I'll ask for not a dissertation on the yield curve, but just simply the yield curve inverting. And pardon me, because again, I'm from New Jersey, but if on the right hand of the screen, your screen, my left hand, this is short-term interest rates. And on the my right hand, your left side, this is long-term. Short-term interest rates, have they inverted, gone higher than long-term interest rate? Has that happened?
Yes, that has happened, and that's
leads to.
Yes, it's a really unusual situation because long-term interest rates should be higher than short-term interest rates, and so people see it as a marker of a recession. And if you go back through history, it's been a very strong signal for recession. And we've got lots of signals for recession. Though at the moment, we've had 2 negative quarters of GDP growth. It's people are debating definitions, but we know that some elements of the U.S. economy appear to be in recession. It's a very unusual recession because we're going through a recession with very low unemployment. And normally during a recession, of course, you see high unemployment, see people laying off. We're still seeing strong demand. In fact, that's one of the problems. But we're seeing negative growth. We're seeing this inverted yield curve, which is very unusual, and pressures a recession. So I think the key thing to remember is that this situation is unusual because it follows the pandemic. And what we've seen is one big economic pulse that's run through the economy. And so one mistake that I think investors might be making at the moment is to hear the word recession and think that they know what the future holds, because we've all been through recessions before, and many recessions are quite similar, and so people assume they know what the next step is. But this could be quite different because of this economic pulse that's running through the economy from COVID. So just bear that in mind, and as Lou says, it's all about the long term, not about what's happening today or tomorrow or the next week or even the next couple of months, because that period's uncertain.
Good. Thank you for that. And I appreciate that plug as well, because I'll take everyone I can get. Okay. That's for sure. So the world, we again, in preparing, we talked about the world as a very volatile place right now. You mentioned at the start of the conversation, we have a war, and I'll say it every time. I can't believe in 2022, we haven't figured out a way to have no one end up in a war. So we have a crisis in Europe that could lead to a food crisis in Northern Africa, as we discussed, because people of Northern Africa live on, they eat grain. That's what they eat, and it's not coming out of Russia and Ukraine. So we have a war creating a volatile situation of supply chain, food, financials, as we discussed, increase, and politically. So this conversation we had about it led to expectations, and you brought up a very interesting conversation or article which you shared with me, which is great. The investor expectations, and we're not here to give anybody that's listening a hard time. We love these people, okay? But we want to share this from a context standpoint, because we've had this amazing run after COVID in the market to now, or to the last, say, 9 months. I mean, this basically January 1 came and the market started dropping. The expectation of clients versus advisors, or I should say investors versus advisors, how did that become so disconnected? And do you mind sharing the number? Because I thought it was a rather remarkable number, and I want you to quote it.
Yeah, absolutely, Lou. So this was a survey of investors in the US and around the world. It was done by one of the big investment management firms in 2021. That's important. And the average expectation for the real return from equities annually for the next 10 years was around 17% a year. And if you think about the magnitude of that number, it's absolutely enormous in terms of money doubling and doubling again over that period. And so it's a hugely ambitious expectation. Now, when you look at the expectations of financial advisors and investment managers, then it was more around 6%. A year, which is in line with the historic averages. And so there's a huge disconnect between some private investors and the advised investment professionals that serve them. And I think we can see the impact of that with how some end investors have invested very aggressively over the last couple of years in these quite expensive companies that we mentioned earlier, growth type companies, and with these expectations of very high returns, a very positive mindset. And of course, what happens is when you have a fall in prices, people change that mindset. That's why we get this sort of momentum in markets. It's not about prices necessarily finding their true level. It's about the fact that the herd mentality that we all feel has changed, and people have moved from this very over-optimistic expectation of what's ahead to probably a more pessimistic expectation. So that's important to bear in mind as people think about their own investments. Then it's worth remembering that all of our expectations were probably a little bit too high last year, and for many investors they were far, far too high. And as we see the markets, that leads us to adjust those expectations if we're not careful, and we can turn being too optimistic into being too pessimistic, and that's the way that the market moves. But that's 17% versus about 6%. If you put it in terms of cars, that for an average investor in the US, an average size 401k, then that would make the difference in either having an Aston Martin or not having an Aston Martin at the end of 10 years. So people are expecting an extra Aston Martin, and that's a pretty high expectation. And so you have to remember the impact that this change in sentiment can have on markets.
Well, and I think that's a great plug for a British car manufacturer right there in the Aston Martin. Okay?
I do my best.
Yes, James Bond would be proud of you right now that his ride has been referenced on Tranquilli Financial Advisors meeting. Just as a reminder, we're talking with Dan Kemp, Global Chief Investment Officer, the Investment Management Group of Morningstar Investments, and you led into this beautifully with the expectations. You talked with me in one of our conversations that I have with you and other professionals about discounts versus bargains, and I would really like for you to I'll sit back and listen, take a couple of sips from my Tranquilli tea there. All right. That's every all details are thought of here, Dan.
That's an even better plug than mine.
That's not bad, right? So, and by the way, thank you to the clients who sent that up because they found it and loved it. So please define a discount versus a bargain, because right now, and you know this, we've talked about it. I feel pretty good about looking past this market, and we'll get to that. Okay, just stick with discount and bargains right now. But I feel pretty good about it, and giving some advice on investing right now in stocks. So if you would define those two words as you see them, someone who is managing. Well, can you share the amount that you are the global chief investment officer of?
Yeah, it's around about a $250 billion.
$250 billion.
Yeah,
you're qualified, Dan. Okay, all right, let's have it. Discount versus bargain.
Okay, so first of all, we have to start with the idea that there's a fair price for every company in the US. And that price reflects a perfect expectation of what those cash flows that I mentioned, those dividends and share buybacks and the eventual sale price, what an expectation of what that would be over the long term. Now, of course, all of you are now thinking, well, you can't possibly know what that's going to be. And you're absolutely right, which is why share prices move. If we all knew what the perfect price for a stock would be, then share prices would never move. They just reflect the price of that stock, but they do move because there's uncertainty. And so what happens, as we mentioned, there are times when stock prices rise very rapidly and go well above a reasonable estimate of that fair value. We can all estimate what the fair value is, and sometimes prices go well above that, sometimes they go well below that. When they go below, then you get higher expected returns. When they go above, you get lower expected returns, because we need to assume that the price of a company will move back towards that fair value over time. Think of an old-fashioned clock with a pendulum. You can start the pendulum at one side, and it swings past the bottom of the curve, and then on from there, and it swings back and forth. That's exactly like a share price. And so when we were thinking about whether a stock is a good investment or not, one of the things to do is compare the current share price to the fair value, the estimate of fair value, the bottom of the pendulum, if you like. And when you're doing this, then it's important to remember that the key piece of information is not what the share price has just done, but how it stands relative to that fair value. And so what we sometimes see is share prices fall, as we've seen over this year, and people say, look, shares are at a discount. They're at a discount to what they were worth. We all love a discount when we go shopping. And so people say, look, shares are discounted from where they were. But there's a difference between a discount, so a share price is lower than it was before, stock price is lower than it was before, and a bargain, a stock price that is lower than the fair value of that business. And when stocks become very expensive, you can experience quite a sharp fall in share prices, quite a steep discount in share prices, but it's still not necessarily a bargain. And so that's the key piece of information that all analysts need to focus on when you think about the current share price. Not about where it's come from, but does it represent a bargain to a reasonable estimate of its fair value? So most of our time is spent trying to work out what the fair value of different investments are and where the stock price is compared to that. So think about it when you go shopping. You can see a sale price, but sometimes that sale price doesn't represent good value. It's just a discount on the previous price. Lou, did that make any sense at all?
It made perfect sense. I'm going to sum it up in a moment, but can you give that guy behind you a map? Because he just keeps going back and forth.
We have a lot of that. Yeah.
It's fine. And I just can't help but notice, squirrel. He's like, headed back and forth. Hello. So anyway, the discount versus bargain, it would, I guess you go into a store and they have towels on sale for, 5 for whatever, $10. And you buy 5 towels, you get home, you have 50 towels piled up. You may have received a discount on the towels, but was it good enough? Did it do anything? Was there any benefit to that? Whereas if you had one towel at home and you went and bought the same 5, well, that was a bargain to you because you need more towels in the house. So that's not exactly perfect analogy, but I'm doing my best as it applies to towels and home goods. I don't ever buy them. So anyway, it's perfectly reasonable. So can I follow that up with this? Do you think we're in discount or bargain territory, or is it more of the broad view that some are at a true discount from fair value and others are just a bargain from their very elevated prices?
Yeah, and that's obviously the most important question right now. And one of the challenges that all investors face is that people tend to use a very broad brush when they're talking about the stock market or a particular country even. And what we have to remember is that the global stock markets are made up of thousands of individual companies all doing slightly different things, and on top of that, you have all the different industries and even the different country markets as well. And so, when thinking about whether stocks currently represent a bargain or are just discounted, then the key is to look at quite a granular level. So when we look at the US market, what we see is that the large technology companies, although they've fallen a long way, they still don't look like they're in bargain territory to us. Now we're just one view, but as we look at it, they don't look like a bargain to us. Equally, other companies in the US, other parts of the US market, do look far more attractive, and particularly we've seen the moves of late. We're starting to get some good opportunities there. But overall, the US to us is one of the most expensive markets in the world. And we're seeing particularly good opportunities in some other parts of the world. Now, some of these are large markets. So Japan still looks quite interesting, despite the economic challenges I mentioned earlier. But Japan looks quite interesting. Germany looks quite interesting because people are so negative about Germany. But that's a country with some really fantastic companies that are involved in exports around the world, and these companies will be very difficult to recreate. They look attractively priced in the UK. When we were preparing for this conversation, I wasn't too enthusiastic about the UK last week, but you may have seen in the news that the UK has had a bit of trouble over the last week or so.
A tad.
And the UK is now looking much more attractive for US-based investors. So it's really important to not think about just whether stocks are high or low. That happens sometimes, but normally there are parts of the market that look attractive and parts that look less attractive, and that's the benefits of being granular and looking at different ways of looking at the market, different investing philosophies, different investing styles, to try and catch those opportunities where they arise.
Well, I appreciate that, and again, the plug for Tranquilli Financial Advisor from. So, if you want. Everyone that's listening now, everyone that listens to the replay of this, and if you are here with us now, thank you so much for being here for the initial discussion. We are recording. We'll have the recording process and sent out to all clients. Sarah will be taking care of that within the next week or so for us. You've just given a plug to Tranquilli Financial Advisor because, Dan, as we've talked in the past, even though you proved you could walk on water to me with your investment acumen. I don't know if that's compliant to say. So we'll just say, even though you've proven that you can do a great job, no one gets it all here. And that's because I always say clients can put all their eggs in Tranquilli's basket because we will not put all of their eggs in one. The theories, and I respect and appreciate you so very much. And just one of the reasons is that you have that perspective. You did understand what I was getting at, that other investment firms, they see it differently. And that's where the point is so well taken that you made. There isn't one correct way. You applied it to the Fed. There isn't there's no perfect investment. There's no correct way. Conversations like this are what lead, I think, to thorough, thoughtful, well-placed decisions on where to invest. So I can use just this is countryeconomy.com, just so I reference it for compliance purposes, this is actually as of yesterday's market close. The Dow Jones Industrial Average year to date down 18.31. The NASDAQ, the small company exchange, my personal favorite to look at, the down 29.36% year to date, and the Standard & Poor's 500 down 21.97%. And that's available on Bloomberg.com and any other, even Morningstar.com. Let's give the credit where we should. So those numbers, you mentioned abroad, there's a tendency to look at the market, to say the market. And by the way, guilty as charged, okay? Because I just get into the mode of looking at the whole thing, but there are different pieces of it. And I let you know, we use other names here, a company like Beacon that we work with, or Horizon that we work with at this time, or DFA. They may see these pieces differently than Morningstar, but that's the point, is that we have multiple theories working on a client portfolio. Those are three very U.S. based stock indexes, and even with those numbers broadly, you're saying that doesn't necessarily represent a true discount, that there may be just bargains, if you will, baked into those numbers.
Yeah, Lou, that's absolutely right. That even though we've seen those sharp falls, if you look at a stock chart, and you certainly can get that on Morningstar.com as well as other places.
Sorry about that. Yeah, should have led with that. All right.
No, that's good.
My bad. That's it. When you get to 300 trillion or 300, what is it? You said $250 billion, 300 billion. Then I'll mention Morningstar.com. Yeah, that's
fantastic.
It's a goal for you.
Side step is there. So if you look further back on the stock chart, what you'll see is that although we've had these sharp price falls, really in the US market, we're probably only back to the prices that we saw around about the end of 2020. And so it's, remember earlier I was talking about this big COVID pulse that went through the economy and also affected stock prices. So it's a lot of people were saying in 2020 that markets didn't look particularly cheap at that time. But of course, every time they make a new higher level, we tend to take that as being the fair price of the market, and then when it falls back from there, we think that it's possibly a bargain and certainly discount it. But the key is to think about it from that fair value. What is the fair value for these stocks? And even though we've seen those sharp falls, in the case of some companies, say like those large technology companies and some others, although they've fallen a long way, they've started from such a high level that we would really see those as discounted, but not yet bargains. But even that, actually, sorry, just add one more thing. Even then, I'm talking about a market sector within US technology. There'll be some companies that look more attractive and some less attractive. That's the importance of going really deep into the analysis and not just painting with a broad brush. And as you said, get that diversity of views.
Diversity of views. Love the thought of it. So we're right at about 40 minutes. Time flies when you're having fun, Dan. So I'm gonna ask you to take us out of this current environment. How do we see through it? Where do we see the end of 2022? What is the inflection point that pushes us upward, even if we are negative for the year? How do we get from where we are now to a less negative finish to the year?
Yeah, well, I think the key is there to focus beyond the end of the year as we look at the next 3 months. I think it's very likely that we'll hear lots of bad news. We could see stock prices falling sharply, stock prices rising sharply. But unless anyone's planning to spend their savings on the 31st of December, then the most important thing that people can do is really focus on trying to block out all of that market noise, all of that economic noise that we're all hearing, and really think about the long term. It's incredibly difficult to do. If I can spend a minute of your time. The analogy I like best is the story of Odysseus, the ancient Greek hero coming home from the Trojan Wars. And he had to sail past the island of the Sirens. And for any classicists there, the Sirens were these creatures that issued this incredible song that would drive sailors mad, and they'd wreck their boat on the shore, and they'd all be lost. So what Odysseus did was two things. First of all, he forced his crew who were rowing the boat to stuff wax in their ears so that they couldn't hear the song of the Sirens. And so one of the things that people can do is just try and avoid all the financial media, avoid the financial pages. They're only going to drive you in the wrong direction. Listen to Lou. Ignore all others. It's okay. And the other thing that Odysseus did was he had himself tied to the mast. So he could hear the song, but he couldn't respond. And that's the other thing that we all need to do. Make sure that we're not making short-term decisions, particularly not to cash in savings because we're worried about what's going to happen next, 3 months or 6 months. It's all about looking for those bargains, making careful decisions, and thinking about the long term. If you do that, like Odysseus, you will get past the island of the Sirens.
All right. Well, I love that story, and we'll talk more about that offline right after we're done here. Dan, I can't thank you enough. Garrett, thank you. I did see that we had Brian from Morningstar also here joining us. Dan, is there anything else that we didn't touch on? I mean, I love wrapping up with that great story, that great comparison. But if there's anything else that you want to add, like you'd like to come back and do this again sometime,
I would be delighted to come back.
All right, good.
If your clients can stand me for a second time, then I'll definitely come back.
Well, how's this? We'll get them used to the accent, and then we'll keep them going. So thank you everyone for joining us today. Genuinely appreciate it. Dan, thank you so much. Mitch, thanks for being here, and we'll be in touch with everyone to talk more about this. We will send out a recording of today's video. We welcome you to share it with friends, family, colleagues. We're glad for them to watch it as well, and thank you all again.